Welcome to Get Rich Education. I'm your host, Keith Weinhold. When you seek a property manager, how do you screen them? What should you ask? And what terms should you expect to see in your written property management agreement between you and your manager? Also, what's perhaps the best housing market in the United States that we've never discussed before? Today on Get Rich Education.
Learn the easiest way to create wealth and passive income with real estate. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those investment properties. Narada Real Estate saves you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more at PassiveRealEstateInvesting.com and download your free copy of the ultimate guide to passive real estate investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateInvesting.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome to Get Rich Education. I'm Keith Weinhold, and I'm so grateful to have you here for the 225th episode of Get Rich Education. When you're about to put another property into your portfolio, sometime before you get to the closing table, you need to sign a management agreement. That's the document between you, the investor, and the property manager, and it outlines what duties the manager is going to perform to you, how much they charge you, what they will and will not do, and other details. Do not immediately rule out a property manager because it seems like they're charging you a higher fee. Property managers who charge a lower initial fee, that may or may not work out. They might just be charging more for duties that they consider extra and most wouldn't, such as filling vacancies, paying bills, handling maintenance issues, and handling eviction procedures. Well, those activities right there, all of those things are really a central part of what a property manager should be doing for you. They should make your life easy. Managers should handle nearly all of the property and tenant responsibilities and tasks related to taking care of all of your tenant needs and requests, as well as maintaining the property. From hiring inspectors to look at your property and dealing with marketing efforts to interviewing prospective tenants and collecting rent from current tenants, managers are the ones that are typically accountable for the intricate details regarding the daily operation of your property. Now, if a minor repair comes up on, let's just say, your tenant's oven range, let's say one of the heating elements needs to be replaced, and that part costs $30. Well, you should not have to hear about that in some special email that your manager sends that they're informing you that they're going to replace one of the heating elements in just one oven range in just one of your units. Why would you want to be disrupted for something so minor? Oftentimes there's a portal where you can log in and look at your ledger whenever you want to. But instead, your manager has the right to charge you, say, $30 for that heating element and then a few dollars for the labor. And then at the end of the month on your property management statement, you see what day that work was done, and that repair money is deducted from your monthly rent proceeds. Essentially, anything that you don't want to handle for your property or things you need to be sure are inside your property management agreement. You need to read the management agreement closely to determine what services are actually included in the management fee and what services are considered extra and require additional payment. For example, most managers, they're not going to get involved with the administrative busy work of refinancing a property for you. That is not a manager's job. That's work that you or someone else has got to do. Now, on the other hand, you need to make sure that the management fee doesn't exclude some items that you should consider necessities, like the manager should be the one collecting the rent, finding tenants. When you have a vacant unit, they're the ones that are going to be making sure the property is clean and showable for the next prospective tenant. And the manager should be marketing your vacant property, and they should be handling any emergencies during the tenancy duration. Also, when you sign a property management agreement, expect to see that many of them do prevent you, the property owner, from placing a tenant in the unit yourself. Why is that? That is meant to protect the property manager from having to manage a tenant that hasn't been selected according to their guidelines. Now, what about when it comes to entering a unit? If you own the rental home and you've hired a manager, don't expect that you can enter the property unless you first notify the tenant beforehand or get approval from the property manager. Now, when it comes to equal opportunity housing, you want to make sure the management agreement has a section that says they support equal opportunity housing. It should say they will follow both state and federal fair housing laws. What about the contract duration, the length of your management agreement? How long should that agreement last? You want to try and avoid signing a long-term agreement until you have some proven results from and confidence in your management company. But do understand that most management companies will not sign a contract with you for less than 1 year. So get a referral, get a manager that already has a good reputation and a good working relationship with some people that you already know about, preferably. You will want to review the termination clause in the agreement because you want to make sure that you're able to terminate the contract if you are unhappy with their service for some reason. So we're talking about management agreements today, how much you should expect to pay for management, and just what that manager should and shouldn't be doing for you. Let's continue our chat with today's guest. We're bringing in Brian here to discuss real estate markets, property management, and more. Welcome to Get Rich Education.
Thanks, Keith. It's fun to be here today. Thank you very much.
Brian, when an investor is interested in buying an income property, before they get to the closing table, it's a very good idea for that investor to have a signed, executed management agreement in place. So we're not talking about the lease agreement, which takes place between the manager and the tenant, but rather we're talking about the management agreement, that agreement between the investor of that income property and the manager itself. So talk to us about what makes for a good, sound property management agreement between the management company and the investor.
You can be more right. And that's something that a lot of new investors, I think, don't realize, because it's real easy to get caught up in the, I guess if I call it the fun part, and that's doing your research and buying the property. But, long after you buy a buy and hold property, an investment property, the property management company is going to be with you for a very long time, hopefully. So you need to have, it's a balance, but you need to have a comprehensive document that's going to spell out what the management company's role is and what they're going to do. But if it's too long and there's too much legalese, it makes it very difficult to work with. So I think it's important to have a good comprehensive document that will spell out. And then, it's almost impossible to imagine every contingency. You can be hit with things like natural disasters and storms and stuff like that, where you can't possibly plan for every single contingency. So I don't know that you want to have a 70-page document. Our company uses one that's about 10 pages long. And on the turnkey side of the business where we're selling, we can even cut half of that out because we have all the property information because we've either rehabbed it or built it. But the specific agreement about our commitment to the owner and what we will do, and that's very easy to spell out.
We're talking about that management agreement between the investor and the management company. I think just in general, the most basic thing is spelling out what that manager's responsibilities are, which means what are the things that that manager will do for that investor during the lifetime of this property and of their management of it, and what will they not do? And besides just duties, what do they charge?
Exactly. It's interesting because there are varying degrees of property management. We happen to be a full service management company, meaning that, we'll find you a tenant, we'll vet them, we'll sign an annual lease with them, and we'll put them in your property. Not everybody does that. Some companies won't. We can take care of your property. And if there's repairs or anything like that that are needed, we'll do that. We have a maintenance reserve that is spelled out that becomes the threshold for the amount of work that will be done on your property before you're even contacted. In regards to our company, it's $350. So if the tenant wakes up in the morning and calls us and their hot water's not working, we're going to send somebody out to troubleshoot and fix that. And if it's under $350, we're not even going to call you. We're just going to go make sure that the hot water's on and it's working. If we get out there and it's more than $350, that's when we contact you, and that's when you get to decide what to do. We'll give you an estimate for us to fix it, and the choice is yours to use us or use a different contractor.
Most property managers have the duties of filling vacancies in your property, paying any bills for you that come up on that property, dealing with any maintenance issues, and you're bringing up the maintenance reserve amounts. Your default amount is $350. Now, you as an investor typically have the option of bumping that up. If you don't want to get bothered about a $400 bill or a $400 charge there, for example, you could bump your maintenance reserve requirement up to $1,000. So it really depends on you, the investor's liquidity that you have, and just the amount of passivity that you want in your investment when you help determine the maintenance reserve amount that's placed into your management agreement.
Correct. Yeah, and the other thing to consider, so many of our owners don't live in our market. They're a pretty good distance away, so they rely very much on us. They rely on our judgment. They rely on our skill. There's a lot of trust put in us, and that's very important. So the agreement, and getting back to what we were talking about, you want to sort of have the minimum sort of things that are spelled out in that, and they need to be detailed as much as possible. But then you get to where you have a relationship. Very hopefully, you have a good relationship with your property management company. And over time, they understand exactly what it is you want and things that you won't do.
Now, another place where a property manager's responsibilities interface with the fees that they charge might be, does your property manager give you complimentary ongoing inspections annually or quarterly or every 6 months or whatever as part of their maintenance fee? Tell us about that, Brian.
Well, I couldn't agree more. And that is something that we do. Ours aren't complimentary. It's an optional service, but it's one that I highly recommend, that somebody needs to go out and be inspecting the property. I call it putting eyes on the property. In the case of our company, what happens is you'll have somebody go out and do pretty thorough interior as well as an exterior inspection. What happens is the person will go out, they'll take pictures. Generally, the pictures start if there's any deficiency in the report, like if they find a leak, or if they see where there's something on the outside that needs paint, or there's an obvious problem. They'll take a picture of that and it gets put in the report. But it does two things really, really well. Number one is it ensures your tenants are in compliance with the lease. We hear horror stories all the time about somebody that has never gone out, never looked at their house, and then the tenant leaves and they find the house is trashed, there's a lot of damage. And the best way to ensure that that doesn't happen is to have somebody go out and inspect it. The other thing is we tend to find things when they're small problems before they become really big property damaging problems. Houston is a warm, humid climate. Air conditioning runs here a lot of the year, probably 6 months, sometimes more. What happens when you're running central air conditioning is there's a water drain. If that gets clogged up, you can have some pretty severe water damage in a home. So if you're out there, that's one of the things that gets checked. It's not something that a lot of people even really know to do, but our people are trained to do it. So when they go out, they'll check and make sure that the drain is working properly, that it's not going into the emergency pan or anything like that. And those are the little telltale signs that can make a big difference.
It's not the type of thing that you only want to find out about 2.5 years after you bought the place and that tenant is vacated. You want to find out about that substantially sooner. Talk to us about handling extensive renovations and how much the property manager does there. Now, of course, when someone buys a turnkey property, it's already been rehabilitated. So oftentimes you don't need to do an extensive remodel for 10 years or more.
That's right. Keith, that's a great point. We do, and we have the capabilities of doing extensive renovations. And that actually is something that grew very systemically out of the property management side of the business. We were doing make-readies and repairs on rental properties, which just kept growing and growing. And again, very easily got into where we can do major renovations on properties now. I think that's, again, part of what you want to understand very well with your management company. And there should be definitely have some stop gaps in place. I will spend this much, but not this much. And then you also have to have a little bit of trust because when you get into a renovation, we've probably all seen or heard of this where, there can be more extensive damage than what was originally thought. You go to replace some cabinets and find out that there's problems behind where the cabinets were. And all of a sudden, you've gone from what you thought was going to be this much money spending on the project to you've got this much money and now a little bit more. So I think that's something you have to be aware of.
What's interesting is when it comes to handling remodels and does a property manager do it, I want to kick it back to you, the investor listener here. If you are holding on to any one individual property for more than 8 or 10 or 12 years, I just want to ask you why you're even doing that. As often as we talk about the power of leverage in doing cash out refinances or 1031 exchanges into the next property, a lot of times just at historic appreciation rates, and there certainly are many exceptions to this, oftentimes after 8 years or so, you might have enough equity accumulated in that where it makes more sense to 1031 and move that equity along. And when you invest in single family homes, you can often go ahead and sell that to an owner occupant that isn't looking for any particular numbers or anything. And they'll be happy after you've owned it for 8 years and they own it for another 4 years, say, and just the 12-year mark replacing the water heater or whatever it is. So a lot of times it makes sense to not hold for more than 8 to 10 years. So again, there are plenty of exceptions, but the extensive remodel thing, that just really isn't situation normal necessarily for a turnkey investor.
You're right. I kind of think of us as a property management company first because we manage over 750 properties here. And we're a turnkey provider, kind of that sprung out of the property management side. And I can tell you that I've seen a lot of people, especially new investors with us, that got involved with us through the turnkey side of the business. They would buy a property or 2 properties because everything was done for them. I mean, that's the beauty of turnkey investing is you basically have a property that you buy and you're making money from the very first day. But over time, they got the experience. They got a little seasoning and a little confidence under their belt. And they come back to me with a management agreement. And I'm like, hey, this is great. Where did this come from? And they said, well, I was in the market or I got a great deal on a property and I know you guys can fix it up and I wanted to add this to my portfolio. And I've seen that happen very often. But it all started with the turnkey purchase and that and interfacing, and doing well with the property management company. They got the knowledge, they got the skills, and they got the confidence to go out and buy a property on their own and then let us rehab it.
I would advise don't fall in love with an income property. You might fall in love with the home that you live in. There are some touchy-feely things there. Maybe that's where your kids were raised, where you grew up playing soccer with them in the backyard. But when it comes to income property, it's the numbers that make sense. When you have enough appreciation to be at a 2-to-1 leverage ratio, you really want to ask yourself, do you want to hold on to this or not? So Brian, give us an idea of the fees, for example, that you charge at your company. You own about 750 units in your management portfolio there in the Houston MSA. Typically, there's a management fee and a leasing fee. You also mentioned that you do have an additional ongoing inspection fee. So just break down some of those fees for us.
Sure. First of all, to find you a qualified renter, in the industry jargon is called a lease up. Basically, when you have a vacant property, you need a good quality tenant to put in there. So the process works like we market your property just like a realtor would on the MLS. We also put it on our website, and then we take applicants that are interested in renting that, and we vet them. We put them through background checks, several different types, and we sign an annual lease. And that whole process is called a lease up. We charge 75% of 1 month's rent to do that.
Okay, so to attract a new tenant when there's a vacancy, you will charge 75% of the first month's rent as a leasing fee to that investor, which is on top of the ongoing management fee.
Correct. And then we have a tiered management fee program, and we feel pretty strongly, and this works really well for us. We only work off of, we don't have monthly fees, Keith. We don't care for that. We work off collected rent. And what that simply means is if you're collecting rent for your property, you're making money, so are we. And the contrast to that is if your property is vacant and you're not collecting rent, you're not making money and neither are we. So it keeps us highly motivated. It keeps us motivated to keep your property rented for the highest amount of rent that we can get for it.
That's a great model. You as an investor want to be skeptical if your manager is still charging you the management fee even when your unit is vacated. You don't want that. You want to align interests and have your manager be motivated to get a tenant in there so they can begin collecting their management fee.
Keith, I can tell you that Houston's a great market. It's very competitive. There's a lot of companies here that are in the property management space. One of the things that you find is there's many different ways that people come to own rental properties. Some of them are pretty obvious. Sometimes it's intentional, and very often they have what we call the accidental landlord, where maybe it was a divorce, an inheritance, or something like that. Now they own a rental property and they really don't have any experience. So there's a lot of people like that. Some of them self-manage, and you'll have actually quite a few companies market to that segment of the people with very low monthly fees. If you're sitting there and you're feeling the pain of, wow, I'm tired of dealing with the tenants, I'm tired of turnover, I'm tired of fixing this property, and then you're listening to the radio station while you're driving to work or watching the television, and the ad comes on and says, hey, let us manage your rental property for $75 a month. Well, I mean, that's one of those things, be cautious, I would say.
Right.
It sounds too good to be true. Well, sometimes it turns out it is. We're more of a full service property management company. I know I mentioned earlier we have a tiered structure, but our fees are pretty simple. We work at 7.9% of collected rent is full service management. And then we also offer what we have a premium management for 2% higher. It's 9.9%. But what the additional 2% buys you is eviction protection, which is important. We put a renter in your property and they stop paying rent, we'll evict them and you won't have to pay for that. Here in Houston, you're looking at about $400 for an eviction, and that can go up pretty quickly. It can go up to $600 if we have to do a writ, called a writ of possession. The other thing we do is we talked earlier about the lease up, right? So you're going to invest 3/4 of a month's rent to find a good qualified renter. And if that renter leaves for any reason before the term of the lease is up and you're on our premium program, we will find you a new renter and you won't have to pay another 75%. So here in Texas, it's not unusual for a house to rent for, on average, say $1,500 a month. And the difference between the 7.9 and the 9.9% is only about $30 a month. And for that $30, you're basically getting eviction protection, and you're also getting a tenant placement guarantee, which if you're a serious investor and or you have multiple portfolio, that's something that's of great value to you because it takes all the worry out of your tenant placement.
So you have a two-tiered management fee, either 7.9% or 9.9% if you want the eviction protection. That's kind of nice. You have an option there. Not every company offers two tiers and options with the management fee. You talked about the leasing fee, and then also you have a bit for an ongoing inspection fee if that is a service that you want. So We're talking about the interface that you, the investor, have with the property manager and that document that binds you together called the management agreement. The last one I signed was 4 pages long, but I did need to get it notarized. You're listening to Get Rich Education. We're going to come back and talk more about real estate markets and management. I'm your host, Keith Weinhold. MC Lobsher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the #1 strategy of investors in his holistic wealth creation course at yourownbankingsystem.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
Hi, this is Rich Dad Advisor Garrett Sutton. You're listening to the always valuable Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. Brian and I are having a discussion about property management and real estate markets, really keying in lately on that management agreement, that agreement between you, the investor, and the property manager. And Brian, you're there part of an award-winning franchise, really one of the largest in the nation. You're owned and managed by the same family turnkey company. It's all in-house, and you're highly automated and systematized there. Houston is really probably one of the most forgiving real estate markets in the entire nation. Tell us more.
That's correct. We're one of the companies where when you deal with us on a turnkey, once you buy the property, you get turned over to the property management company. And I think it's really important because they're one and the same. They're the same ownership. We're run out of the same building by the same staff of people. And so there's a great deal of accountability. And I think that's what is very important. So you're not dealing with one company to purchase your property and then another one to manage it. You're dealing with one company throughout. What we like to say is, hey, if something is not exactly right with your property, we're going to be here on the long haul afterwards. And that's important to a lot of people. As far as, you mentioned the forgiveness and how forgiving this market is. There's over 3 million jobs here in the greater Houston area. That is hard. It's hard for people to really get a perspective on that. I saw something recently that said there's more jobs in the Houston area than there are in 35 states.
That's astounding.
It really is, because we led the nation again last year in job growth in the construction industry. So it tells you a couple of things. From a turnkey investing point of view, we're very under inventoried in rental properties here. And one of the fastest growing things is the construction industry here, to try to keep up with that demand, because our population has grown. The economy here has just been in a diversification and growth mode for the last 25 years. And it has put us on the trajectory that we're on now, which is everything. All the investing lights are green here. It's really a lot of fun.
Realizing that we have listeners in 188 world nations, we're talking about Houston, Texas, in the south central portion of the contiguous United States. Houston is the 5th largest metropolitan statistical area in the United States, and they're the 4th largest in the size of the city. So within just the MSA, the Metropolitan Statistical Area, which is really the entire agglomerated area, we're talking about a population of 7 million people. This is a large market, and it's growing fast. In fact, in the top 20 United States MSAs, none in the top 20 are growing as fast as Houston. In fact, just since the last census in 2010, Houston grew over 17%, adding about 1/6 of their population just since then.
You know what's causing that, Keith? One of the major reasons for our growth is that the cost of entry to get into this market is so low. you can buy a house here, it's 26% below the median for the nation. So it's very inexpensive to get started here and to get going. And the market is under inventoried. There's a lot of demand for rental properties. And it's just been a real bonanza for investors. I like to say it's a very forgiving market. I can't think of one that is more forgiving in the United States than Houston, Texas right now.
It is hard to think of one. There's one obsolete paradigm that some people still think of oil with Houston, but when you have an MSA that's this large, it's also substantially diversified. In fact, I think just colloquially, if you think about how a couple decades ago, there was a team there named the Houston Oilers. When they left town and then the new franchise for the NFL came back around the year 2002, they weren't named the Houston Oilers anymore. It just isn't an appropriate moniker. They're called the Houston Texans. So just talk to us more about diversification across economic sectors, which is so important to a long-term real estate investor. In case there's a drag in any one economic sector, you're still going to have jobs and you're still going to have rent-paying tenants.
You're absolutely right. And I'm so glad you brought up the Oilers because that is very true. That's what the stereotype is, that, the Texas market and Houston in particular, and we still are. We're very much the oil and gas capital of the world, but we're very fortunate that about 25 years ago, some of the state leaders and local leaders realized that without diversity, we were in real trouble. And there was not a good economic model here at that point, being so heavily dependent on one industry like that. So they did something, believe it or not, it was very controversial. And we saw it again in the end of, I think it was 2017, when the United States passed a big tax break. And it was controversial because they cut taxes and they started giving tax abatements to other industries. It shouldn't surprise anybody, but a lot of companies moved here. And they moved their headquarters, they moved their manufacturing facilities because they had huge incentives to do that. And what happened was they brought a lot of jobs to the Houston market. And the jobs made opportunity and brought a lot of people to the Houston market. And it has continued now for 25 years. And we've seen the oil and gas segment of our economy shrink from where it was in the 90s. The economy was so much into the Oilers that they actually named the football team the Houston Oilers. And that was back in the day, and it was 75 to 80% of the economy. Today, it's 33 to 40% of the economy. So it's been cut in half or less of what it used to be. And I'll tell you, the other nice thing is oil and gas is pretty much a contrarian segment of the economy. So when oil and gas is doing well, it's not always a good indicator that the other segments in the economy are going to be doing well. So many other segments have grown. It's not so much that the oil and gas has really shrunk. We've just added so much. We have technology that we didn't have before, transportation, manufacturing has come back here very strong. So it's a very diverse economy, and it's a wonderful thing to have the oil and gas sector there and be well represented like it is, but we don't rely on it anymore.
I seem to remember old school NFL quarterback Warren Moon of the Houston Oilers had an oil derrick on the side of his helmet, but that was 30, 40 years ago.
Come on, it's J.J. Watt now. We're J.J. Watt.
Yeah, that's right, with something different on his helmet. You have 10 of the top 50 master plan communities in the nation right there in Greater Houston, 20% of them. You led the nation in construction job growth. And, I really think a recent substantial litmus test was when the price of a barrel of oil began its decline from about $100 down to $50 4 years ago. Houston still didn't feel pain.
Correct. Friends in the oil and gas industry have told me that they've had to learn how to do more with less. Honestly, I didn't really know what a master plan community was until I moved here. In the Texas area, the master plan community really took off. And what it simply is means that you have not only residential areas that are planned out, but also schools and hospitals, shopping, entertainment. That truly is. It's planned out, and there are areas that are left to build them and things like that. And they're prominent down here. And they're also something that it seems to be taking and doing well in other parts of the country. But the growth here last year, 10 out of the top 50 were located in Houston, Texas area. So the homes that are being sold here, the growth is, again, off the charts.
Well, you're in a market where the numbers make sense. Some places have thriving economies, but the numbers on properties don't make sense, but they do there in Houston, where you have a relatively high ratio of rent income to purchase price. Now, in 2017, to help with inventory constraint on your turnkeys, you started constructing brand new single-family homes, infield lots in neighborhoods that you know well. And then in 2018, you began building new construction duplexes, turnkey, that you can offer to investors. Just tell us about the price points for your turnkey single-family homes and for your turnkey duplexes.
Sure. That's a great, again, the cost of entry to get involved here. And we're selling new construction properties that are anywhere from 150. We're going to start offering them this year at about 150,000 price point. That's a 3-bedroom, 2-bath, about a 1,200 square foot home. And then we have a slightly larger version at 1,600 square feet, 3-bedroom, 2-bath, 2-car garage. That's going to be about 160 to 180,000. The duplexes were a big hit last year, and we're going to offer them. We've got a few more coming online again later this year. Price point on those is under 300. We're at about 285, 275, 285 for a 3,000 square foot duplex, 1,500 square feet on either side. They're going to be renting for $1,350 a side. So the money mechanics work out really well. This is a market that you can manage both cash flow and appreciation. That's kind of rare, but Houston's been that way now for quite a while, where you're able to get both cash flow and appreciation.
Yeah, in fact, I'm looking to get down there myself this year, maybe to scoop up a few of these properties for my own portfolio. Brian, are there any last things that our listeners ought to know about management agreements or turnkey properties?
Well, I think we covered management agreements pretty well. Again, you want something comprehensive and thorough. You don't want it so long that it's going to bog you down, and you've got to have some trust and build a relationship with your management company. And then as far as coming to visit in Houston, we always encourage people to do that. And if they can make it down here, we'd love to entertain, and we'll take you around and show you the market. Budget about a half a day to come down here, and we'll show you some new properties, and we'll show you some remodeled properties, and you'll learn a lot about the market.
If you'd like to do that yourself or look into this market or buy some turnkey properties remotely, that all starts at getricheducation.com/Houston, where Brian has placed a report there for you so you can read more about this market and see if it's right for you. Brian, it's been great having you here on Get Rich Education.
Thank you so much, Keith. I enjoyed it.
You might be asking, why didn't I discuss the Houston market here on the show sooner? Population-wise, Houston is the largest of the strong investor markets that we've never discussed before. Well, there's just so much to discuss each week. And it's funny how pro football quarterback Warren Moon's name came up. I do know some football history. And in 1985, when he played for Houston, I was alive then, but I was pretty young and I sure wasn't watching football yet. The largest medical center in the world is in Houston, and there are 7 different teaching hospitals there, abundant medical jobs and growth. And as we've discussed on prior shows, Texas is a landlord-friendly state. Oftentimes you can get an eviction in about 30 days, and Texas has one of the most business-friendly climates in the United States and perhaps even the entire world. Lots of growth and jobs means lots of rent-paying tenants. Now, Brian's company started years ago with rehabs. They would turn distressed properties into very nice turnkey rentals, kind of HGTV flips. More recently, since there are housing inventory shortages nearly everywhere in the USA, what do you do when you have a shortage? Well, you start building new, and they began building brand new construction, infill, single-family rentals, and now brand new construction duplexes as well. Visiting a market in person is helpful, but you sure don't have to visit the market before you buy. The majority of turnkey properties that I've bought in my life, in fact, were bought completely sight unseen. Now, why would I do that? Or how could I have the confidence to do that? That is because, again, the market and the manager are more important than the property. and I won trust in them first. In fact, I have bought turnkey property before in my life, owned a property for a number of years, holding on to it for cash flow, and then I sold it for a profit years later, and after all that, I never saw the property that I once owned, and I likely never will. The Houston provider has a good reputation. In fact, Chaley Ridge from Ridge Lending Group has said some good things about them and that they've put up great returns for their investors. And their properties are also known for being value-solid properties from the perspective of their appraisals coming in favorably. So this is something highly actionable for you here after we talked strategy on the past few shows. You were just introduced to one of the providers at GREturnkey.com. That's our newest provider in Houston. A win-win for you could be starting your loan qualification with a company like a Ridge Lending Group. If you want to add income property to your portfolio this year and think as much about the Houston, Texas income property market as I do, take action. Get a hold of the investor report that Brian put together for you and then connect with the provider directly. You can do that at getricheducation.com/Houston. That's getricheducation.com/Houston. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
As America's third largest city, Chicago, Illinois has big economies of scale for real estate investors. But there are problems with investing in highly taxed, fiscally strapped Illinois. You can beat it when you invest in Chicago land, staying on the Indiana side of the state line. Your property tax on a median Indiana home is less than half that of an Illinois property. Forbes ranks Indiana as one of the top 10 states to do business. With typical rents at $1,250 and purchase prices at $125K, Northwest Indiana numbers work. Learn more and connect with the turnkey provider at getricheducation.com/Chicago. That's getricheducation.com/Chicago.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at getricheducation.com/book. That's getricheducation.com/book. Because invest in what produces income for you now and later. Sign up now at getricheducation.com/book.
The preceding program was brought to you by your home for wealth building, getricheducation.com.